What's up guys, Americana back with another video. In this video, we're going to be talking about all the reasons that I know the Fed has to cut rates and fast, as well as what this is likely going to mean for the crypto market. So let's go ahead and dive in. All right, everybody, make sure you watch every single one of my videos this week. Please, please, please. I'm not normally that type of person. Everything normally is a standalone video on its own. But these videos all tie in together and they are super, super, super important to watch. I'm also going to have this disclaimer in each one of these videos. They have nothing to do with Bitcoin's price action. They have nothing to do with crypto's price action, okay? We've been sitting around, we've been wondering, we've been theorizing about why this cycle looks completely different from the crypto market. We've talked about Bitcoin dominance being in a completely different place, momentum showing certain signs. We've talked about ETH BTC being in a completely different place, showing different signs. We've talked about others BTC. We've talked about Bollinger Bands and low volatility regimes. We've talked about all these things. I don't think that's good enough. I don't think showing you guys what's going on in the crypto market as prices are tanking is going to be helpful for your faith in the crypto market, which I do still think it should be here. It should be in the crypto market. It should be in equities markets. This video is going to, or these videos are going to dive into something much deeper. Okay, this specific video, this specific topic is going to be talking about the Fed cuts, what that could mean. In other videos, we'll talk about credit cycle. I think in each video I am going to make the point to tie it back to the credit cycle because that seems to be extremely important. That has been extremely important in the past for crypto. And then just keep in mind all those things that we've said in the past as well about Bitcoin dominance, about ETH BTC, all those things. Those dynamics have not changed. We're simply looking at this on a more macro perspective with the outlook that a melt up is still completely possible. I don't believe we're in a bear market. Simple. I'll go down with the ship, right? Every cycle there's idiots who scream that it's still a bull market. I obviously do not want to be one of those idiots who scream still a bull market all the way down here and then they scream it's a bear market all the way up and then they don't end up getting in the market until right there. I don't want to be one of those people. So I'm hesitant. I was hesitant to make these videos, but the data is showing it. I mentioned in the live stream, I'm going to go down in infamy one way or the other. I'm either going to be the legend who said it wasn't a bear market and it ended up not being, or I'm going to be the idiot who bag held the entire thing down and screamed it was a bull market the entire time. The data is showing me things. I've been doing this for a long time. I've been in crypto for a long time. I've been in markets for a long time. I've been in economics for a long time. And when things aren't quite lining up, typically I'm a firm believer that the data is always there. It's always in the charts. Markets are efficient, maybe not each market individually on its own. But when we look at things as a whole, when we look at especially stuff in credit, all right, that's billions of dollars, trillions of dollars, some of the biggest institutions in the world, places you don't even know about, people you don't even hear about, driving these factors of the economy, the cost of money, the amount of money in the system, all of these things. And it's super, super, super important to look out for. So first for this video, like I said, we're going to talk about Fed cuts. The Fed is going to cut. The Fed's going to cut. I know there's certain cuts priced in, but honest to God, they are going to cut sooner than later. They're probably going to cut more than people anticipate. And I think it's because they have to, and there's also plenty of room to, right? There's plenty of room to cut. We're safe on the inflation side, but there's also the factor of the employment side. Every time Powell gets up, he says you have a dual mandate, inflation and employment. Currently, the risk is on the employment side. You can't change that fact. It is simply on the employment side. And that's where we're going to start going through here. And then we'll talk about how the Fed rates thus far have moved with inflation, how that's affected the market, tie back into the credit cycle. So long introduction, but hopefully you guys stuck around. Hopefully you guys watch this video, enjoy it. Hopefully you guys check out my other videos this week because they all kind of tie into the same thing, okay? So the first thing we have pulled up here is non-farm payrolls. Non-farm payrolls is a good, explainer, good thing to look at for the underlying health in the labor market. I have Dow Jones in green and I have Bitcoin in blue up top. And let's go ahead and dive in. You can see each of these past cycles, or not even crypto cycles, sorry, but stock market cycles and things like that. I'm just marking, I guess I should, I'll go ahead and mark the top of the stock market. I think that's best. It's always a little bit hairy to which one you want to mark, because when we look at this economic data, we want to look at what the data was showing leading up to it, and you want to look at what the data was doing after it to confirm the fact that we were in some sort of bear market. But we can see each time labor is strengthening, right? Labor is strengthening into these moves. Okay, even to get out of these moves in here, labor was strengthening. A strong labor market means a lot of things. It means that, the economy is growing. If I threw GDP on here as well, you probably see that growing as well. Plenty of people have jobs, people are making good money, all of the things that you need for a strong economy to take place. Now, while that's happening, if it's happening because of artificially low rates stuck at zero, that can have a long-term effect on the economy, to where eventually the labor market actually starts shrinking and the Fed can't do anything about it, because if they raise rates, when you raise rates, that pushes down the labor market as well. That contracts the economy. So they're kind of burning the wick at two ends in most cases, but currently, and we'll get to it in this video, they're burning it at one end. They're very, 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 very close to causing a recession on their own accord, which I theorize that they will not do. You can see that again in each of these past cycles, once labor has rolled over, that has been very poor for the economy. The economy is contracting. People are losing their jobs. Production will decrease. Durable goods orders will decrease. Same stuff we talked about in other videos this past week. So please make sure you go, or this week. So please make sure you go check those out as well. COVID is a little bit spotty because we have this kind of whipsaw action. But if we just take this last peak in Bitcoin, peak comes in and everybody is saying we are in this January of 2022 kind of area. Well, what did we see at that time, right? Is we saw the labor market sliding. Okay, you can assume that if Bitcoin was around for these times back here, it would have benefited from this strength in the labor market with those kind of lower rates. But we did not get to see that as cleanly here because of COVID. You can see this thing was sliding. We've currently stabilized a little bit, but as you guys have known, we've had a few rate cuts, one or two maybe. I can't remember the exact number, maybe two, maybe three, whatever it's been. But labor is in a very critical point. This zero line here represents the difference between contraction and expansion. So anything over this zero line is going to mean that the labor market is expanding. When you see it declining, but it's still positive, it just means it's declining, or it's increasing at a slower rate, which can also be an early sign. But you can see that once we have crossed this zero line, it has been really, really not good. That's when the really heated parts of these recessions come into play. All right, if we zoom in here, you can see we are not at that point yet, but we are getting close. Now, what is the one thing that can fix this? Again, we talked about that dual mandate from the Fed. What is the one thing that can fix this? That is going to be cutting rates immediately and aggressively. Cutting rates is going to increase inflation, but that's fine because we have plenty of room on inflation, which we will also cover in this video. But cutting these rates is going to prevent us from basically artificially producing our own recession, which I pointed out in the live stream that I don't think that's going to happen. The Fed had to navigate some pretty insane times here with volatility in the labor market, as well as just an overall kind of constricting labor market because it was different because of COVID while inflation was high. It's my opinion they did a pretty good job of it. So my point is, why now would they keep rates high into this move here, just completely allow the labor market to contract and restrict into a recession when they have plenty of room on the upside, plenty of tools on the upside to fix this? So now let's talk about that kind of room. We covered PCE in other videos. PCE is a good indication of inflation. This is what the Fed looks at, right? We have yet to see a rise in inflation at all in this cycle, whether you're looking at the stock market or the crypto market. You see kind of rising inflation into this move. see rising inflation into this move and begin to taper off, we have had no rises in inflation. So I do want to add some other charts on here as well. These are not my charts. Grab these from articles and stuff like that. I don't have access to Bloomberg, but we can still show you guys what's what. But anyways, this is the inflation surprise index. I don't think you guys can see my cursor, which is a little bit annoying. All right, fix that problem. Thank you, TradingView. I didn't want you guys to not be able to see my cursor there. We'll go ahead and make this a little bit more transparent, and we should be good. Nice, you guys can probably see that. So this is the inflation surprise index. When this thing is moving up, that means inflation is surprising to the upside. Again, pointing to PCE down here, obviously it's been nothing but down. And you've seen this really kick into place within the last year or so. A little bit of a upthrust in inflation surprise when we look at March, April, May, because of tariffs and stuff like that. But since then, I mean, in the last 8 months, 9 months, 10 months, inflation has actually been surprising to the downside, meaning when those inflation numbers come out and it says expectation versus actual, that actual number has been lower than the expectation, okay? i.e. the surprise to the downside. So really good sign there that the Fed has plenty of room to cut. All right, the next chart is going to be credit cycle liquidity. To fully understand this, we actually need to take a look at another chart first. And this is going to be forward-looking inflation expectations. Let me go ahead and remove this on here. But we can see, in combination with the PCE data that we've been showing, people are not, or the financial industry as a whole is not expecting inflation to increase. You can see in each one of these previous tops, we've actually had increased inflation expectations after the peak came in. And this is kind of the overheated side of inflation. We see increased inflation expectations, right? We see increased inflation expectations. Thinking back to October time, right? We have not had that show up. We haven't had inflation expectations continue on just yet because inflation is not a thing right now. The threat, like I mentioned, is from the labor market. So bouncing back to this chart, what does this show us? Up top in the white line here, we have the 2-year yield. If you guys don't know, the 2-year yield is very, very, very closely tied to the Fed funds rate. It's about as close as you can get without just copy and pasting the Fed funds rate. It follows it very, very closely. And then below in orange, we have the 2-year inflation expectation, or the just in general inflation expectation. This spread in between is extremely important because this is what we would call the real cost of money. As this spread gets closer together, that means money is cheaper. That means the real cost of money is cheaper. And the spread is reflected down here. You can see as this thing gets tighter, this spread decreases. We'll talk about what that means in a second. And there's a couple reasons why this spread can contract and expand and things like that. If we see up here, again, this is the closest thing we have to the Fed's fund rate. You can see Fed fund rate was relatively flat in this time. This is looking back to May, June, July last year, April, May, June, July. But that inflation expectation was rising a little bit, okay? This isn't always a bad thing. Inflation goes up when there is more liquidity in the system. So if there was liquidity in the system for other reasons and things like that, that inflation is typically going to rise. But we see this decline in the spread. What does this decline in the spread time up with? Again, this is, if we started from right here, this is May of 2025 all the way to end of August of 2025. If we go over to Bitcoin's chart, it would be really prevalent on Ethereum's, but this is, right here. This is the little tariff fiasco in here, but this is this entire move up, right? Before September, before October came in and we kind of got that top to form on Bitcoin, that's that entire leg up. So obviously very good when we see this spread come together. Okay, now something I want to point out is we've since seen it come away. Fed has remained flat a long time. The Fed has remained flat. no cuts, no nothing, and inflation expectations, like we showed on the other chart, have continued to decline. Thus, this spread has increased. So this is September until really bad around end of December. And again, like I said, the spread has increased. So if we said it was good when it decreased, it's poor for us when it increases. Now, what we have here is kind of this little double top pattern forming, right? As inflation's expectations rise just a little bit. But the main thing I want to focus on is the Fed has all of the tools to fix this. If they simply cut down to here, down to half a basis point, that would be 3 right there. So half a basis point, 0.75 basis points, something like that. This spread is going to get insanely tight. We're going to see this spread decline, and we're going to see money flow into the system like we have yet to see in a while. And again, why is the Fed going to do that? They have plenty of good data to support it. Inflation expectations are extremely low. If we look at PCE, right, PCE is pointed downward. We have not had a spike in inflation in a long time. And at the same time, the risk is coming from the labor market. The only thing that is going to stimulate this labor market is a cut in rates. Now, what is the market pricing in? I mentioned that we would tie it back to credit in each of these videos because that is going to be the ultimate driver of the economy. If people are lending, if people are increasing credit, what they're doing with credit, how much credit there is, all of these things, we are going to see liquidity increase, especially for our assets like crypto. I have absolutely no worries about this chart here. Again, this is HYG. This is corporate credit, high yield corporate credit. So riskier credit terms when this thing is pumping. We are in a risk on environment. If you don't believe me, okay, I can take when we found the bottom in here and what the markets ended up doing, right? Dow Jones broke out of its all-time high as HYG caught a bid. Okay, if that's not enough, if you don't believe that, we can look at past times we've been in what is apparently similar points in a bear market in crypto. And what have we seen is this corporate credit declining. What have we seen into a peak and after in previous bear markets, right? This corporate credit declining. When were we able to find a bottom in crypto in past cycles? When this corporate credit caught a bid. This is true time and time again. Corporate credit catches a bid, crypto goes up, stocks end up going up because there is credit in the system. And now what do we see once we come into this top phase? Once we come into this topping phase, that is the end of the market, okay? On chart here, I have this lined up with my momentum indicator. This is monthly time frame stuff here. So really good data to look at. When we see this stuff roll over, right, go negative, that's been where we're at in these bear markets, and we are not anywhere close to that. So people are fading risk assets right now. People are fading crypto. People are fading equities. People are fading all of these things, but the market is literally pricing in more risk on. The credit market is pricing in more risk on. Just had its monthly close. That is a great monthly close, in my opinion. If we drop down to the weekly time frame even, let me get this out of the way so you can see. We had a cross up on the weekly time frame, right, into some bullish momentum. Everything building up, looking like credit is going to return to the system. While the Fed is about to cut rates, while the Fed has to cut rates, while the risk from the Fed is only one-sided, it's coming from the labor market, it is not from inflation. There's plenty of room to cut rates. And I'm not saying I'm even going to stick around while the Fed continues to cut rates because at some point, the problem is going to come from the inflation side of things. Like we showed in PCE and like we showed in other videos, the rise in inflation becomes a problem. And then what you see into the bear market is actually that's when inflation starts decreasing because why? They've probably started cutting rates again. While at the same time, when that same inflation is decreasing, right, we see credit contracting. This is not rocket science here, guys. So fading Bitcoin because of a 4-year cycle or fading altcoins because of whatever, it just does not seem like the play to me. I might be the idiot that, like I said, goes down in infamy as just riding this thing out the entire bear market. But with what we're seeing, even in the crypto market, there's price in Bitcoin, Ethereum price in Bitcoin, Bitcoin dominance, all these things that I've been screaming about for months and months and months. Are still there. They're still in play. We just had a monthly close. Bitcoin dominance is now negative momentum on the monthly time frame. While the stage is being set on the macro scale. This credit market is trillions and trillions of dollars. This is bigger than gold. This is bigger than all these things, right? And if these markets are pricing in more risk on, it's just not something that I'm simply willing to fade. And then even when we look at past cycles, it just has not been the same, right? We haven't had monthly negative crosses. We haven't had massive moves down, all these things. And again, like I mentioned, that Fed risk being more on the labor market side is just, it's not something that I'm willing to bet against. So anyways, we'll wrap it up here. Let me know what you guys think. Like I said, these videos this week are going to have nothing to do with crypto at all. Honestly, the price has become somewhat irrelevant to me. We've talked about certain levels, we've talked about certain things, but as long as these dynamics are in play, it's just another reason why this hasn't looked like past cycles. And it's just something that I'm not going to bet against. You guys are free to do whatever you guys are going to do. You guys can think I'm an idiot. Maybe I turn out to be the idiot, but I have my data to back things up. And it just is what it is at this point. So I'll catch you guys in the next one. Make sure you check out my other videos. See you later. Peace.